So we move to our final chapter, chapter 26, monitoring performance, cost reductions, and value enhancement. Now, although this is the last chapter, it's certainly an important chapter for us. And if we think back to some of the points that I made in terms of just assessing a business and looking at performance, let's remember that this chapter, important obviously for the exams, we'll get questions, but also for your careers. In other words, if you're in a position to be able to evaluate a company, to be able to look at a set of records, accounts, financial statements, etc., and take a view on them and advise, you're in a very good position. We need to understand the mechanics of performance and indeed the difference between poor, mediocre, average, and very, very good performance. So let's open this up as we look at the first three parts within this particular video. The first section here, as you'll see on the left-hand side, concerns basically performance in manufacturing and service industries. And note that that's slightly different. Let's see how. In the first instance, when we think about a manufacturing organization, an organization that produces something, let's say a widget, for example, an imaginary product. There are a number of areas where that particular organization, given how it operates, i.e. it basically churns a particular set of materials, etc., including labor, into a product for sale. There are a variety of things that we need to concern ourselves with. First area really is general ratios. And we're talking about profitability, activity, liquidity, and gearing. Now, if you look at any ratio analysis question in the ACCA exam, whether or not it's financial accounting, linked to MA, or indeed any other subject, these would be the four main heads for ratio analysis. Profitability speaks for itself. We're talking about net profit, gross profit, etc. When we think of activity, we're looking at really the efficiency of the business in terms of what it does. So, for example, things like debtor days, etc. When we think about liquidity, obviously we're looking at cash. We're looking at the amount of cash, and we're looking at things like, the relationship between, let's say, current assets and current liabilities. And there's the ability of a company to meet its short-term obligations. When we think about gearing, we're really talking about debt. We're looking at a business and saying, well, you know what? This particular business is highly geared. In other words, it has a fair amount of debt. Maybe that's a little bit of a worry. Now, debt in itself isn't a worry, but certainly high levels of gearing or high levels of debt should make a business look a little bit more risky because it has commitments, it has loan payments to make, etc. Next area for a manufacturing company is obviously resources and the utilization of resources. At the end of the day, manufacturing is about inputs, it's about some sort of process or manufacturer, and then it's about outputs. So the efficiency or the utilization of resources, be they materials, labor, or anything else, is very, very important. Next area is variance analysis. Now, we've seen variance analysis in the MA course, fairly straightforward as a broad concept, a little bit more tricky in terms of those nitty-gritty little calculations. Got to be careful on that chapter. That will come up in the exam. Obviously, we mean simply comparing budget to actual in a broad sense and really investigating significant differences. Quality, obviously important, particularly if you're producing a product at a high level. For example, let's say a luxury style product. Quality is absolutely key for manufacturing businesses and indeed maintaining quality. Last area, customer satisfaction, something obviously that's become more and more important as a metric over the last 10 to 20 to 30 years. More and more now we see, certainly within the ACCA syllabus, but indeed outside of that in real life, if you're not satisfying your customers, you're going to get a bad review. You don't need that as a manufacturing organization. So really, these are the five main areas, if you will, for a manufacturing business. Let's move on now to service industries. Now, why are service industries different? Why should we measure performance perhaps in a slightly different way? Well, because services are unique. I mean, what sort of things are we talking about? Well, anything from hairdressing, going for a meal, hotels, accountancy firms. These are all services. They're not producing a product as such. And obviously, services can vary from time to time. Let's say the last few haircuts that you had, perhaps you changed location. At the end of the day, it's a service, but let's say the quality was different from place to place and the price was the same. So really, services are in one sense unique because they have a number of qualities that really the production of or manufacture a product doesn't have. They're certainly intangible. How do you measure the quality, let's say, of a haircut? How do you measure the quality of an accountancy service that you've just developed? It's slightly tricky. Outside of that, certainly perishable. There's a start and the end. May well be consistent or inconsistent, as I've just mentioned, in relation to, let's say, your last 3 haircuts. And indeed, simultaneous. So, in essence, services are different. And indeed, because of that, there's certainly a focus in more recent times on looking at the non-financial areas connected with the performance of services. So for example, let's say the time taken, or indeed, let's say the booking process, and indeed the merits of a booking process. So in terms of service industries, let's just note for the moment that they're different to manufacturing industries in terms of performance. What about not-profit or public sector organizations? Again, this third area is slightly different. In what sense? Well, we're talking, of course, about things like charities, government bodies, educational establishments, etc. And really, with these sorts of entities, obviously, the aim is not profit. The aim is to really provide, let's say, value for money, or perhaps to solve a social cause, possibly on a limited budget. I mean, we can't look at charities and think that let's say ROCE or net profit is their overall objective in the course of the next year. Really, they're about social causes. And indeed, when we look at, let's say, government agencies or government bodies, as it were, or bodies that are linked to governments, for example, hospital, at the end of the day, we need different metrics, don't we? So, in terms of different metrics, we mentioned that concept, VFM, or value for money. Now, this area is important to us, certainly within FA, commonly examined, but certainly elsewhere in the ACCA qualification. You're going to see this concept again and again and again. Let's get familiar with it. So, our intro really is to say that, well, for some types of bodies, let's say, for example, a hospital, or let's say a charity, we need different metrics. We need to measure performance in a different way, because at the end of the day, these entities don't have profit or net asset growth or share capital appreciation as their main objectives. So this area of the 3 E's is important to us. Now, what do we mean? Well, we mean a way really of assessing entities that are not-for-profit. What do we start with? Well, let's think about a hospital as an example. Let's start with economy, or if you will, inputs. We're talking about the measure of input-related costs, time, money, materials, and labor. Now, taking hospitals as an example, I could look, let's say, in the last year at the full value of medical supplies. In other words, the costs of inputs. Or perhaps I could look at the salaries of nurses or the salaries of doctors. That would be inputs. And you know what? I'm going to compare last year to this year. So there's a way that I can use this particular metric in the context of a hospital to evaluate the hospital. Nothing to do with profit, nothing to do with net assets at all. What about the second area? Efficiency. Now that's all about the process. Really, we're talking about, the relationship between inputs and outputs. So again, using a hospital as an example, compared to the amount of inputs that I put in, whether that's medical supplies, staff salaries, etc. What are the outputs? How many patients have been treated? How many patients have been cured? So note that this second area of efficiency is, I guess, a measure of the relationship between what I've put in and what I've got out. That wouldn't be overly difficult to do in the context of a hospital. What about the last area relating to this 3 E's? Effectiveness. We're talking about outputs. We're really looking to link the outputs to the objectives of the organization. I mean, what would be the objectives of a hospital? Well, broadly speaking, to cure people, to treat people in the local area. So in essence, there you have it. We have the 3 E's. Now this in particular is linked, as just mentioned, into the idea of not-for-profit entities. And as I said from the off, this is something that you're going to see again. And, a good little question within the MA exam. Let's make sure that we understand it. Next area for us really is the idea of managerial performance in section 2. Given what we've said about different types of organization, whether or not it's a manufacturing business, a service business, or perhaps an NGO or a not-for-profit. How do we assess management? Well, let's look at this first area here. Let's think about, broadly speaking, a for-profit business, just to keep things simple. If we were to look at a business that has a series of divisions, what's important for us is that where we have, let's say, a business with 10 divisions, let's say geographically spread around the country, what's important in terms of assessing managers of those divisions is that they're only assessed on what they are under direct control of. In other words, that if the manager can control something, then obviously that should be part of his assessment or appraisal. But if he or she can't, then it should not be. So in terms of considerations, and we've seen these terms in the course so far, what sort of things do we think about? Well, certainly when we're thinking about a cost center, then clearly a cost center is where managers are only able to control costs. Let's assess them based on controllable costs. What about a revenue center? Well, clearly revenue and controllable revenues only, not revenues that are outside their control. What about a profit center, which brings together the two? Obviously, it's all about profit. It's about the difference between controllable costs and controllable revenues. Last area, we bring in basically investments or decisions in relation to, let's say, capital equipment purchases. So again, just to recap here, we're saying that when we're looking at managerial performance, we need to ensure that we only assess performance based on what's controllable, whether or not it's a cost center, revenue, profit, or indeed an investment center. Now note that this area of controllability versus non-controllability, again, as I said up top, is a thing that you'll see repeated in several different subject areas within the ACCA qualification. So make sure that you understand it. So in essence, what we're saying is that, controllable costs and revenues, I guess, in effect result in controllable profit. And indeed, controllable profit is an area that is commonly associated with metrics such as the return on investment, ROI, and indeed residual income. Now again, these are two areas that for the MA exam we've got to be savvy with. We've got to understand the calculation. There's a couple of options in relation to how you calculate these. Choose one, learn it, and indeed practice. Okay, so let's look at the sort of mechanics. One area that's important in these calculations is the idea of imputed interest. Now, what do we mean by imputed interest? Well, what we mean basically is an interest charge, at the cost of capital or at a given interest rate on capital employed or net assets. So let me turn that into slightly more simple term. What we're saying is one part of calculations when we're looking, let's say, at assessing divisions is to calculate an imputed interest charge on the amount of money that has been employed in the business to generate profits. When we move on to this next section, we'll see this in use. So let's look first at return on investment. Okay, now what do we mean by that? Well, in terms of return on investment, we are talking about controllable profit divided by controllable capital employed. Now you may be wondering right just now, well, what does controllable profit mean as opposed to non-controllable profit? When we do the questions within the portal, we'll get more familiar with the mechanics and indeed how the examiner thinks, and with the little tricks that he's going to play in terms of perhaps including an element that isn't controllable and then seeing if you extract that to get to controllable profit. So there's one option. Remember I said that there were more than one. There's one option in terms of the calculation. Perfectly fine to use operating profit divided by net assets, either or. But my advice is choose one and learn it, okay? Now, in terms of the next area, residual income. Remember, ROI and indeed RI, residual income, these are just two metrics that we would use perhaps when we were considering assessing a series of managers who are head of a series of divisions. So what's the calculation on residual income? Again, controllable profit minus imputed interest on capital employed. We saw the calculation up top in terms of the imputed interest. If you don't remember it right now, don't worry. Bottom line is that we need to be able to simply say, okay, well, you've employed an amount of capital in this business. What we're going to do is, from that capital, we're going to calculate imputed interest and we're going to deduct it from controllable profit to get what we call residual income. Note also a second option in terms of the calculation, not overly complex. Again, let's choose one and stick with it. Easy to get confused if you're using, several at the same time or in different questions. I choose one and stick with it. Okay, so we've seen the two calculations. Remember, with each of these chapters and each of these mind maps, as I've said previously, the mind map walkthrough videos are one thing, but there's nothing that's going to get us away from doing the activities in each chapter. I've said that quite a few times over the last 25 chapters or thereabouts. And indeed, over and above that, let's remember the OT section of the course, practice, practice, practice. Okay, so we talked about two possible metrics. In the study hub, you'll see application of RI and ROI. So as I've just said, let's make sure that we work those examples and those activities. So what about sort of, advantages or disadvantages of ROI? Now, let's not think that these areas are not going to get examined in the OT questions. They will. We're going to get questions on the difference between the two, a comparison of the two, and indeed advantages and disadvantages. So let's deal with return on investment first in terms of advantages. Now, I've just done a job lot here. Let me walk you through them. It's certainly similar to the calculation for ROCE, although ROCE uses profit before interest and tax. So clearly it's widely known. ROCE is probably one of the go-to profitability ratios, generally speaking, in ratio analysis, perhaps outside of the net profit margin or gross profit margin. So broadly speaking, it'll be familiar to finance people and possibly some non-finance people. Second area for us in terms of an advantage is that the information used to calculate it is quite easy to find in a set of accounts. Operating profit, for example, or indeed net assets. It's not difficult. What are net assets? Net assets are just the difference between assets and liabilities. That's it. That's net assets. Simple enough. Okay? So the information is easy to find. Now, in terms of point number 3 here, it's a relative measure. In other words, it produces a percentage So really, when we're looking at, let's say, 10 different divisions, if we were using ROI as the measure, then we should be able to compare the divisions quite easily, because the calculations will be broadly the same, and each of the 10 divisions will have a separate percentage ROI. So useful in that sense. Last one here, it's certainly commonly used, and indeed it could be used to make sort of comparisons between different organizations. In other words, separate organizations, as opposed to just simply separate divisions within a given organization. Okay, so there's the 4 main advantages. Now, what about the flip side? What about disadvantages? There's always going to be disadvantages. Okay, so what we've said here in the first instance is that, in fact, the controllable costs and revenues, which impact upon profit, can be challenging. Now, it's always the case when you see lists of advantages and indeed disadvantages within the ACCA syllabus. I always find it amusing that on the one hand they sort of tend to say, well, the information is not really easily available, and then they'll say exactly the opposite, and that's broadly what we're sort of saying here. We're saying that perhaps controllable costs and revenues to some extent may be difficult to find. What I mean by that is maybe that there is some subjectivity associated with what is a controllable cost or a controllable revenue. Remember that in the formula we're looking at controllable costs and revenues. So in one sense there's a little bit of a contradiction here. Second area is that in terms of the ROI calculations, certainly these are very widely used and commonly used when assessing divisional managers. But certainly when you think about a company that has a lot of divisions, 10, 20, 30, 40, there may well be other areas that are important in terms of the assessment of their performance. So ROI, yes, useful, but it may not give the full story. Outside of that, number 3, this is an important one, I think. One of the areas, or one of the phrases that's commonly used across the ACCA syllabus and can be used within MA is this area of dysfunction or dysfunctional behavior. And really that's what number 3 is talking about here. Let me explain. It says that ROI may lead managers making decisions that will be best for their performance measure rather than the organization as a whole. Now, that doesn't sound good. We don't want that. We don't want them acting in their own best interests. We want them acting in the interest of the organization. Now, what do we mean? Let's break it up into an example. Well, for example, let's just say that manager of Division A is looking at a project that has a positive RI, a positive residual income. In other words, the calculation's been done and it comes out at 50,000. But when you do the calculation on ROI, it may lower the manager's ROI. So it could be that that particular manager rejects that particular project because it lowers their ROI, even though it has a positive RI. So you can see what I mean by dysfunction, or indeed dysfunctional behavior. We're really saying that these measures, RI and indeed RI, could contradict each other and could lead to behavior that the organization as a whole does not need. Okay? Outside of that, number 4 here, it says that ROI values make a false impression of being high when old NCA or non-current assets are valued at their net book value. Now, what do we mean by that? Well, we know that the net asset element in relation to the ROI calculation will be based on just that, net assets. So, in other words, if we're valuing NCA or old non-current assets, I'm talking about equipment, furniture and fittings, etc., machinery at net book value, it could be that the bottom of the fraction is lower than it should be, which obviously results in the fraction being higher, or the ROI value going up, a higher percentage because of the lower bottom. Okay, so watch for that. Let's look at our next area now, and this is residual income. Again, advantages and disadvantages, and it works both ways. So first things first, in terms of the use of operating profit or controllable profit and capital employed net assets, generally easily available from the accounting information, broadly speaking, okay? Outside of that, and this is in contrast obviously to the ROI area, the residual income calculation results in an absolute value. 20,000, 50,000, 100 million, whatever it is. So, if that's what you were looking for, if you felt that that was more useful perhaps than a percentage as produced by RI, then maybe your RI or residual income calculation is the one to go for rather than that sort of relative value. Okay? So there's the two main advantages. What about disadvantages? Again, same comment as above in terms of ROI. Maybe finding controllable costs and revenues could be challenging. Outside of that, same story again. The idea, let me just move this across so you can see it, okay? Yes, ROI, really, really good. Very, very useful. But maybe it's not the full story. Maybe there's a number of other factors that are impacting upon divisional managers' performance, and RI doesn't build them in. Outside of that, we know that the RI calculation uses this imputed interest charge. Now, interest charge, the calculation, whether it's the cost of capital or another interest value, it's got to be estimated. At the end of the day, when you look at a business and say, okay, well, I need to do an ROI calculation, I need a percentage figure, let's say, for cost of capital, there's a little bit of guesswork going on there. So because of that, you might say that the RI calculation is sort of undermined. Okay? Let's move on from there now to section 3. So this will be the final section in this particular part of the video, and then we'll move on in the second video to the second part. Benchmarking. So let's recap so far. We've looked at a number of different areas. We looked at manufacturing organization, service industries, not-for-profit. We were thinking about the 3 E's, if you remember, economy, efficiency, effectiveness. Then we moved on to divisions. We talked about, ROI and RI. We talked about the pluses and the minuses. We looked at the calculation. Here's another way that we can look at performance of businesses. Benchmarking. Now again, I'll remind you, benchmarking is going to be within a number of different subject areas. Let's get a fix on it now. First off, what do we mean by benchmarking? Well, I always think benchmarking is about like looking in the mirror. It's about the comparison of an organization's performance measures to the best in the organization's industry, or possibly to internal departments or divisions, or perhaps even to best practice, for other companies in different sectors. So bottom line is benchmarking is about comparisons in one way or another. Why bother? Why compare you? Well, you want to get better. You want to improve your performance. So if there's a company, in the industry within your country that's a world leader, how? What are they doing? Let's copy them. This is common sense. Okay, so there's the definition. Now, what about different types? Now, this is important, okay? Understanding that there are many, many different types of benchmarking is certainly key to getting some of the questions in MA correct, but also going forward in terms of your real pure detailed understanding of benchmarking. Generally speaking, when I speak to students and I say, okay, well, let's talk about benchmarking. Generally speaking, they think to themselves, well, there's only one type. It's a competitor. We're just going to compare ourselves to that competitor. No, there's quite a few different types. First one, internal. Okay, so we're looking at an organization comparing the performance of its different divisions, let's say, or departments. Now, these could be departments in completely different areas. So, internal. What about the next one? Competitive. This is the obvious one. Let's look at the most successful organizations and see how we compare. And indeed, let's make changes where improvements can be achieved. So we're looking outside the organization. Who is doing the best? Let's copy them ASAP. What about functional? Well, this is quite straightforward. We're really looking at, an organization comparing its process of performance with a top performing organization in another industry which performs a similar function. So note the difference here between this and indeed competitive benchmarking. Here we're talking about a function. So what would be a function within a given business? Well, how about marketing? Let's compare ourselves with ABC Limited that are in a different industry but that have a brilliant marketing department. So we're talking about the function itself, okay? Last area for us, strategic, okay? So really what we're talking about there is high-level areas. So for example, market share, or let's say profitability ratios, with other organizations to improve itself in the long term. So when I think strategic, I think of high level stuff. I'm not talking about nitty gritty day-to-day stuff, functions, etc. I'm talking about high-end stuff, market share as an example. Okay? So we'll start now on the next video in a moment. I hope that the first 3 parts there made sense to you and that you'll join me for section 2. Thanks for listening.